All right, just imagine this for a second. Picture the scene. It's autumn, 1907. New York City, really across the whole country, there's this palpable anxiety hanging in the air.
Yeah, you can almost feel it.
And news is spreading like wildfire. Banks are in trouble. Seriously, deep trouble. Not just, one or two.
A whole chain reaction.
Exactly. People are literally running, sprinting to their local banks, desperate to get their savings out.
Their life savings, in many cases.
But so many get there and the doors are locked. The money's just gone. Meanwhile, the stock market, it's plummeting.
Total free fall.
Businesses can't get those basic short-term loans, the ones they need just to make payroll. Credit, the economy's lifeblood, it's completely frozen.
It's just seized up.
And this terrifying situation, this sheer panic, it wasn't some freak occurrence. It was just the latest, maybe the worst of these financial crises that kept hitting the U.S. economy before something big changed.
Before a fundamental shift happened.
So today, that's where we're diving deep into that specific crisis, the Panic of 1907. We want to peel back the layers, understand the chaos, where it came from.
Its roots, yeah.
And crucially, how it really acted as the catalyst, the absolute push needed to create the institution that was specifically designed to stop this kind of meltdown.
Federal Reserve System.
Exactly. We're going to unpack the blueprint, the original plan laid out in the Federal Reserve Act of 1913. We're using sources that trace the history of U.S. financial regulation and key bits from the act itself.
That's right. Think of it like we're tracing the path from, almost financial anarchy to a more structured system. Mm-hmm. We'll look at what existed before 1907, get into the mechanics of that specific panic as our sources describe it.
Right.
And then we'll really examine the core design, the powers, the whole intent behind the Federal Reserve System as it was first set up.
So our mission here is really to give you a solid grasp of this absolutely pivotal moment in American financial history, straight from the materials we've got.
Let's do it.
Okay, so to really understand the panic of 1907, we have to set the stage first. You need to get a feel for the U.S. financial system as it was for decades leading up to it. And the defining word, fragmentation.
Absolutely. Fragmented. From the very start of the U.S., really. Financial authority was split. You had the federal government and you had the individual states both having a say.
Which sounds complicated.
It was, and it's deep in the American DNA, this sort of tension between central power and states' rights. It meant early attempts to create something like a central bank just didn't stick.
Well, the first Bank of the United States, Hamilton's idea.
Exactly. Set up in the 1790s, functioned a bit like a central bank for its time, but its charter ran out in 1811. Congress didn't renew it.
Why not?
Intense political opposition. People worried about its power wasn't even constitutional, especially folks in agriculture, wary of, the big finance guys.
Okay, so that one failed. Then there was the second bank.
Yep. After the War of 1812 kind of showed, hey, we need some financial stability here, but basically the same story.
History repeats.
Pretty much. More controversy, political fights. You get Andrew Jackson and his famous bank war. Its charter expired in the 1830s. So these efforts to centralize financial power, rejected.
The political will just wasn't there.
Not sustainably, no. Which left the U.S. with this. Well, sometimes it's called free banking, but more generally, a system where states mostly let the market handle bank regulation.
And the consequences of that.
Pretty dramatic. Think about this. States could charter banks, okay, and those banks could issue their own money. Their own banknote.
Not U.S. dollars.
Not like we think of them today. You'd be using notes from, say, the Bank of Albany or the Merchants Bank of St. Louis.
Wow. And how did you know what they were worth?
Well, that's the thing. The value depended on the reputation, the perceived stability of the specific bank that issued the note.
So a note from a shaky bank?
Might trade at a discount, yeah. Especially if you were far from the bank's home base.
Yeah.
Or even locally, if rumors started.
That sounds incredibly chaotic.
It was. And the source material really emphasizes the result. Constant instability.
Yeah.
Didn't have a central clearing system, no single currency, no lender of last resort.
Yeah.
So bank runs, they happened all the time.
And they could spread.
Easily. If one bank failed, people would panic and run on others. Domino effect.
Yeah.
The stats from back then are pretty stark. About half of all these banks eventually failed. Many didn't even last a few years.
Okay, so that's the backdrop. Volatile, fragmented, unstable. And then comes 1907.
Right, the spark that lit the fuse. Our sources say it kicked off when a group, a cabal they call it, tried to corner a market.
Corner a market, like manipulate prices.
Exactly. They tried to gain control of the stock for a company called United Copper. The speculation itself wasn't maybe that unusual, but this attempt failed.
And the failure had bigger consequences.
Huge consequences because of the fragile system. When the corner failed, it triggered runs on banks and these things called trusts that were linked to the people involved.
Trusts. They were like banks, but maybe less regulated.
That's a good way to put it. Often less regulated, yeah. And heavily involved in the stock market, other financial dealings. Very interconnected.
Any specific examples?
The Knickerbocker Trust Company is the famous one. Its ties to the failed United Copper scheme came out, and boom, a massive run. You had lines of depositors stretching for blocks, terrified, trying to get their money.
And did they?
The Knickerbocker failed. And that failure just sent shockwaves everywhere. Confidence across the entire system just vanished overnight.
And in that world before the Fed, there was just nothing to stop the bleeding, right?
Nothing systematic. No central bank ready to pump in cash, to reassure people, to backstop fundamentally sound institutions that were just facing a temporary panic. No coordinated response.
So this panic, starting from a failed stock manipulation,
amplified by this fragile, interconnected, underregulated system.
It became a full-blown national crisis, and the sources are crystal clear. This specific panic inspired the reforms that led directly to the Fed.
It was the breaking point. The proof that the existing system was just too unstable, too costly, the damage was too great to ignore anymore.
It really laid bare the core weakness, didn't it? That lack of a central authority, a lender of last resort.
Absolutely. The credit freeze that followed paralyzed the economy. Businesses suffered, investment stopped, people feared a total collapse. That sheer terror created the political momentum needed for real change.
Which brings us to the response, the Federal Reserve Act. Passed by Congress, signed into law late in 1913, December 23rd, actually.
Just before Christmas.
And this wasn't just tinkering, it created a whole new thing, the Federal Reserve System, the FRS, basically the U.S. central bank.
A monumental step. One of our sources mentions Jekyll Island in connection with this, too.
Ah, the secret meeting place.
Right, where a group of influential bankers and politicians met back in 1910 to kind of hash out the initial proposal. Shows the level of effort, maybe a bit covertly, that went into designing it.
Okay, so they created the system. Let's dive into the act itself, based on our sources. How was this thing designed? What was its main goal supposed to be?
Well, the act itself, Section 2A, lays out the big policy objective pretty clearly. It says the Board of Governors and the FOMC, we'll get to them, their job is to maintain long-run growth of money and credit.
Okay, growth.
But not just any growth. Growth that matches the economy's long-term potential to produce stuff. And it explicitly ties this to promoting goals we still hear about today. Maximum employment, stable prices, and moderate long-term interest rates.
So that core mission, stable economy, jobs, prices, that was baked in from the very start.
Absolutely. It's the direct answer to the wild swings and instability they'd just lived through.
Okay, the mission's clear. What about the structure? Who actually runs this thing?
It's designed with a deliberate balance, sort of blending central control with regional input. At the top, you have the Board of Governors in Washington, D.C.
You mean board?
Right, 7 members. And how they get there is important. Appointed by the president, but they have to be confirmed by the Senate.
Checks and balances.
Exactly. And they serve long terms, 14 years, staggered. The idea was to give them independence from day-to-day political pressures.
Makes sense. A long view.
And the act says they have to dedicate their entire time to the board's business. They get paid an annual salary. The original source even mentions the first salary, $15,000 a year.
Which was a lot back then.
A very substantial sum, yeah. Signaling this was a serious full-time job.
Were there rules about who could be appointed to make sure different viewpoints were heard?
Yes, definitely. The act tells the president to pay attention to getting fair representation from different sectors: finance, agriculture, industry, commerce. Also, different parts of the country, geographically.
And I think I saw something about community banks later on.
That's right. A more recent change added a requirement. At least one board member needs to have experience working in or supervising community banks defined as smaller banks, under $10 billion in assets. It's an ongoing effort to make sure the board understands the whole banking system.
Okay, so that's the central board. But the Fed isn't just one bank in D.C., is it? There are regional banks.
Correct. There are 12 regional Federal Reserve banks spread across the country in major cities. Think Boston, New York, Chicago, San Francisco, and so on.
And how are they run?
Each one has its own board of directors, operating under the general oversight of the main board in D.C. These local directors manage the bank's affairs. The act stresses they have to be fair and impartial, no playing favorites among the member banks in their district.
So it's like a network.
Exactly. This regional structure was partly a political compromise, addressing that old American unease about having too much financial power concentrated in Washington. It mixes national oversight with local presence.
Okay, central board, regional banks. Then there's the FOMC, the Federal Open Market Committee. Where does that fit?
The FOMC. Hugely important, especially for monetary policy today. Section 12A of the Act set it up. Its members are the 7 governors from the main board,
Okay.
plus 5 representatives from the regional Federal Reserve banks.
Oh, interesting. How are those 5 chosen?
They're presidents or first vice presidents of the regional Fed banks. They get elected each year by groups of the district bank boards. The New York Fed president always has a vote. It's a permanent spot. The other 4 voting spots rotate among the presidents of the other 11 banks.
So it blends the D.C. appointees with the regional bank leadership.
Precisely. The Act says the FOMC has to meet in D.C. at least 4 times a year. In reality, they meet much more often, usually every 6 weeks or so. The chairman of the board can call a meeting, or any 3 members can request one. This is the body that makes the key decisions on things like interest rates and money supply.
Got it. Board, banks, FOMC. Now let's get into the tools, the powers. What did the Act give this new system to actually fight the problems seen in 1907? Like those bank runs, the credit freezes.
Right, the practical stuff. One of the absolute core powers, designed specifically to stop bank runs, was giving the Fed banks the ability to lend money to their member banks.
The lender of last resort function.
Exactly what was missing before. The Act calls it providing discounts, advancements, and accommodations. Basically, short-term loans. Banks could borrow from the Fed using good collateral, like business loans they held, or government bonds.
Were there conditions?
Oh yes. The loans had to be considered safe and reasonable. The Fed had to think about the needs of other banks too, and the overall health of credit, supporting commerce and industry. The Board of Governors sets the detailed rules for this lending. It's known as the discount window.
So, a safety valve for sound banks facing a panic. Direct answer to 1907.
A direct answer. Prevents a temporary cash shortage from becoming a fatal bank failure and spreading contagion.
Okay, so they could provide cash. Did they also get powers to look over the bank's shoulders, maybe try to stop the kind of wild speculation that caused the 1907 panic in the first place?
They did. Another key preventative tool. The regional said banks were required to keep tabs on what kind of loans and investments their member banks were making.
To see if they were getting too risky.
Exactly. The goal was to check if bank credit was being used unduly for speculation. The Act specifically mentions stocks, real estate, commodities, but adds basically anything inconsistent with sound credit.
And if they found a bank doing that?
The chairman of that regional Fed bank had to report it up to the Board of Governors in D.C. with recommendations. And the board had real teeth here. After a hearing, they could actually suspend that bank from using the Fed's lending facilities, like the discount window.
Wow, cut them off from the emergency cash if they're acting recklessly.
It's a strong disincentive, a direct attempt to put a damper on the kind of excessive speculation that fueled the pre-1907 environment.
Makes sense. What about another basic central bank tool, reserve requirements, controlling how much money banks have to keep on hand?
Yep, that's in there too. The Board of Governors got the power to set reserve requirements for banks. These are the rules about what fraction of deposits banks need to hold in reserve, rather than lending out.
And where did they have to hold these reserves?
Primarily as balances right there at their regional Federal Reserve Bank. Or the rules might allow them to hold it as cash in their own vault cash.
Okay.
And an important change came later. In the 1980s, the Act was amended so banks could actually earn interest on those reserves held at the Fed, paid quarterly at rates linked to short-term market rates.
So holding reserves wasn't just dead money anymore. Did the source mention different kinds of reserve requirements?
It did. The Act allows for supplemental reserves on top of the regular ones. But there are strict conditions.
Like what?
They can only be imposed if needed for monetary policy control, not just to fiddle with costs or help with check clearing. And the total required reserves can't be less than what the original Act ratios would have required when imposed. There were also detailed rules about phasing these requirements in or out, especially around the 1980 changes, to avoid shocks to the system.
So reserve requirements gave them another lever to influence how much banks could lend, affecting credit and the money supply.
Exactly. A fundamental tool.
Okay, so they had liquidity tools, ways to curb speculation, control over reserves. What about those really extreme system-wide crises, the unusual and exigent circumstances, as the source puts it. Like 1907 itself, was there a special emergency power?
Yes, and this is crucial. Section 13.3, originally, though modified over time, it gives the Fed authority to lend in those unusual and exigent circumstances, potentially even to non-banks, individuals, partnerships, corporations.
That sounds powerful. Any constraints?
Oh, very strict constraints. Clearly meant as an absolute last resort. To use this power, first, at least 2 board members have to be available and participate. Second, those available members must unanimously agree that, yes, these are unusual and exigent circumstances.
Unanimous. Okay.
Third, they have to unanimously agree the borrower cannot get credit anywhere else. Fourth, it has to be necessary to prevent serious harm to the economy or financial stability, again, unanimous. And fifth, almost unbelievable, they have to unanimously determine they tried but couldn't contact the other board members, and action is needed before they could be reached.
Wow. That is an incredibly high bar. Unanimity, can't find colleagues, national emergency.
It screams, break glass in case of Armageddon, doesn't it?
Yeah.
It shows how carefully they tried to wall off this extraordinary power.
And documentation, transparency.
Absolutely required. Detailed written records of these decisions must be kept and given to absent board members and Congress promptly. And while the lending happens, the details of who borrowed are kept confidential for a time to avoid causing more panic or stigma.
But eventually made public.
Yes, usually after a delay, like a year after the lending facility closes, or maybe longer for specific transactions. The chairman can release info earlier if it's in the public interest and won't destabilize things. And these emergency facilities automatically expire if they aren't used for 24 months.
So a balance between crisis response and eventual accountability. Okay, let's shift to another key tool, maybe the key tool today. Open market operations.
Right, this is the FOMC's main job. The Act gives the Federal Open Market Committee control over the buying and selling of certain types of assets, mainly government securities, in the open market.
How does that work?
It's pretty straightforward, actually. When the Fed buys government bonds from banks or dealers, it pays for them by crediting their reserve accounts at the Fed. That injects money into the banking system.
Increases liquidity, encourages lending.
Exactly. And when the Fed sells securities, it takes money out of the system, soaking up reserves.
Tightens credit.
Right. The Act says these operations should be guided by the needs of commerce and business and the overall credit situation. This buying and selling is how the Fed influences the federal funds rate, the rate banks charge each other for overnight loans, and steers broader financial conditions.
And they have to keep records of this.
Complete records. The board and FOMC must document their policy actions, who voted how and why, and report it all to Congress every year. Accountability again.
So buying and selling bonds to manage money supply the FOMC's domain. Now, besides these big monetary levers, the Fed also got powers to supervise banks, right? To keep an eye on them.
Yes, very important. Ongoing supervision was part of the plan to prevent crises from brewing in the first place. The Board of Governors got significant supervisory powers over member banks and other financial firms.
Would they examine the bank?
Yes. For state banks that chose to become members, the Fed was told to try and rely on state examinations when possible. But crucially, the Fed kept the independent power to conduct its own special examinations whenever it felt necessary.
So they could always look under the hood themselves if they needed to.
Exactly. And they were allowed to share their findings, their exam reports, and other confidential info with other regulators, both federal and state,
Coordination.
and also with the bank's own officers and directors to make sure problems were addressed.
And if a bank didn't follow the rules, what could the Fed do?
They could impose penalties. For state member banks, serious violations of the Act or regulations could even result in losing their membership in the Federal Reserve System entirely,
Kicked out of the club.
which means losing access to things like the discount window. A pretty serious consequence. Though the Act also allowed the board to let them back in if they fixed the problems.
Okay. The Act also seems to have had very specific rules about banks dealing with companies they were related to affiliates. That sounds like trying to prevent risk spreading within big financial groups.
Absolutely. Sections 23A and 23B are all about this. They put strict limits on transactions between a member bank and its affiliates, think sister companies, parent holding company, etc.
Why the concern?
The worry was that a bank might be pressured to bail out a struggling affiliate, or buy bad assets from it, or give it overly generous loans, putting the bank itself at risk. These sections try to build firewalls.
So what are the main limits?
There are 2 main caps. First, a bank's total covered transactions with any single affiliate can't exceed 10% of the bank's own capital and surplus.
Okay, a limit per sibling.
Right. And second, the total covered transactions with all its affiliates combined can't exceed 20% of its capital and surplus.
A limit for the whole family. What counts as a covered transaction?
It's defined really broadly. Loans to an affiliate, buying assets from an affiliate, investing in an affiliate's stocks or bonds, issuing guarantees for an affiliate, even complex deals with third parties that end up benefiting an affiliate. It tries to catch all the ways risk could flow.
And some things were just banned outright.
Yes. A big one is that a bank generally cannot buy low-quality assets from an affiliate. That means assets that are already in trouble, non-performing loans, things classified as doubtful or loss.
Makes sense. Don't use the bank as a dumping ground.
Exactly. There's a tiny exception if the bank had already independently agreed to buy the asset before the affiliate acquired it, but generally it's a no-go. And even for transactions that are allowed under the limits, they have to be on market terms, basically, terms and conditions that are the same as, or at least as good for the bank as, a similar deal with an unrelated company. No sweetheart deals.
So limits, bans, market terms, all to insulate the bank. How did they define who counted as an affiliate?
Also quite broadly. It includes any company controlling the bank, any company controlled by the bank, or any company under common control with the bank. And control itself is defined broadly, owning 25% of voting shares, controlling director elections, or the board just deciding there's a controlling influence.
Seems thorough.
And one really important detail, a bank's financial subsidiary, a specific type of subsidiary allowed to do certain activities, is treated as an affiliate for these rules, not just as part of the bank. So even transactions with those subsidiaries face these restrictions.
That's a lot of detail on affiliates. Really shows they were worried about contagion within corporate groups. Any other regulatory bits and pieces in the act?
Well, the board got general power to issue whatever regulations were needed to carry out the act's purposes and stop people finding loopholes. Very important flexibility. It also specified that the Fed banks could charge fees for the services they provide to banks, check clearing, wire transfers, cash handling, that sort of thing. But the fees had to be based on the actual costs of providing the service. No profit making, just cost recovery for essential infrastructure.
Okay. And what about those state banks that joined the system? Any specific rules for them?
Yeah, a few things. State banks could join, becoming state member banks, and they could also leave voluntarily with notice. But while they kept their state charters, the Fed Board could limit some of their activities to keep them roughly aligned with the rules for national banks.
A level playing field, sort of?
Kind of. For instance, state member banks couldn't lend excessively to a single borrower, similar to national bank rules. It aimed for some consistency within the system.
Got it. And there was that odd thing about lotteries.
Yes, it's quite specific. State member banks were forbidden from getting involved in lotteries, selling tickets, advertising them, letting their offices be used for lottery purposes.
Why? It just seemed unseemly for a bank.
Probably reflects the social views of 1913. But the act did clarify banks could still provide normal banking services to a state government running a lottery, or its employees, just couldn't participate directly. It's a funny little detail, alongside the massive economic powers.
A historical footnote. So with all this structure and power, how does the Fed report back? How does it interact with Congress, who created it?
The act built in regular accountability.
Yeah.
The chairman of the board has to go testify before Congress twice a year, semi-annually.
About what?
About monetary policy, the economy's health, the outlook. And the vice chair for supervision also have to appear twice a year to talk about how the Fed is supervising banks and other financial firms.
So regular check-ins required by law.
Exactly. Keeps Congress in the loop and provides oversight.
Okay. One last detail. The sources mentioned something about transparency for accounts at the Fed.
Yes, this is a more recent requirement. The Fed has to maintain a public online database. It has to list every entity that has a master account at a reserve bank, basically. Direct access to the Fed's payment systems and services.
Who has an account?
And crucially, who requests an account. The database has to show all requests approved, denied, pending, withdrawn with dates. And it has to specify the type of entity, like insured bank, credit union, or non-insured institution.
So you can see who's trying to get access and who succeeds. More transparency.
A significant step towards transparency in who gets direct access to the central bank's plumbing.
Okay, let's step back then. We've got the board, the regional banks, the FOMC, we've got the discount window, open market operations, reserve requirements, supervision, emergency powers, affiliate rules, even the lottery thing. How does this whole complex machine tie back to that initial nightmare scenario, the panic of 1907?
The connection couldn't be more direct. That whole painful history of a fragmented, unstable system hitting rock bottom with the 1907 crisis. That's why the system was built. It provided the absolute, undeniable political push needed for this kind of massive reform.
It forced the issue.
Completely. The Federal Reserve Act of 1913 and the Fed itself were the direct answer. Every major power we discussed, providing liquidity, managing money supply, acting in emergencies, overseeing banks, limiting internal risks, was designed specifically to fix the weaknesses that 1907 laid bare.
It wasn't abstract theory, it was a practical response.
Exactly. A blueprint drawn up to prevent that kind of devastating panic from happening again. It fundamentally rewired the financial system of the United States, creating a central institution where before there was mostly fragmentation and crisis management by whoever stepped up, like J.P. Morgan in 1907.
A really powerful example of crisis driving huge change. So we've journeyed from that shaky pre-Fed world through the fire of the 1907 panic, and now we've really dug into the original design of the Federal Reserve System laid out in 1913, its structure, its goals, its tools.
And the key lesson here, I think, the real takeaway from this deep dive, is seeing that straight line. Systemic failure leads to systemic reform. The Fed wasn't created in a vacuum. It was forged in the crucible of repeated financial crises, with specific powers given to address specific known vulnerabilities. It was a deliberate attempt to build resilience where little had existed before.
Now, as we wrap this up, there's a final thought from our source material. It's kind of provocative, actually, and it loops back to where we started, that idea of fragmentation.
Right. The observation is that even though the Fed was created as this powerful centralizing force, that underlying fragmentation of financial regulation split between federal and state levels, different agencies. It didn't completely disappear in 1913.
It persisted.
It did. And the authors of one source raise a question, maybe some skepticism. They wonder if the current system, even with the Fed, can truly prevent future panics in the long haul, because that root issue, that complex, sometimes overlapping or gappy regulatory structure, hasn't been fully resolved. So it leaves you, the listener, with something to chew on. Did creating a powerful central bank fully solve the problem if the broader regulatory landscape remained fundamentally fragmented? Or does that fragmentation itself remain a potential source of instability, maybe manifesting in different ways?
It's definitely something to keep in mind when you look at financial news and regulatory debates today, isn't it? How much does that underlying structure, that complexity across different regulators still matter?
A question worth considering.
Indeed. Well, thank you for joining us on this deep dive into such a critical turning point in U.S. financial history.
It was fascinating to unpack. A complex story, but absolutely essential.